Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello, and welcome to the Live Life Liberated podcast. I'm Wendy McConnell. Today, we will be speaking with Derek Myron and Sean Clark. Welcome, fellas. How you doing?
Doing great, Wendy. How are you this morning?
Oh, I'm good. Now, why don't you tell me a little bit about you guys, what you do, what your specialty is, and how fabulous you are?
Well, gosh, a little self-promotion early in the morning. I'm here with Sean Clark, Director of Financial Planning here at Centura, and we help high net worth individuals, both C-level executives and founder-led business owners who have high income and net worth north of $20 million, and helping them both with planning and investment management. So I'm here with my compadre, Mr. Clark. Good morning, Mr. Clark.
Good morning, Derek. Thanks for having me on.
Yeah, nice to be back on.
Yes, sir. Always fun.
So today, what are we going to be talking about today, Sean?
So we're going to be talking about kind of unbundling the different services. So here at Centura, we work on planning and investments. And
I don't think that's too unlike a lot of other firms, Sean.
No, exactly. The industry has kind of, become one and the same between a lot of different firms and what they offer. And so we're going to kind of explain what has happened from an industry standpoint over time, how the different service offerings kind of came to be, where they are today, how we think about those things, and where we think things might go from here. So we'll talk all about that.
Great. So the audience should be ultra high net worth individuals, privately held founder-led business owners, and the advisory community who serves them. This podcast is informational purposes, and nothing offered here today should not be considered advice. Okay, we got the lawyers out of the room. Sean, you're the Director of Financial Planning here. You see lots of different cases of people who are super high income and newly becoming wealthy, to people that are very, very large estates and very, very wealthy.
Sure.
And why don't you talk a little bit about the kind of the history of the assets under management fee model? That's become the norm today. I know I got started in the business. It seems like, well, it is a long time ago now. I'm dating myself, 1998. So my 25th year in the business, but that was just getting started in 1998. So why don't you talk a little bit about how did we get from commissions to here? Like, what happened?
Yeah. So just to set a little context for myself. So I joined the industry in 2006. I worked at broker-dealers and insurance companies till 2017. In 2017, I joined you here at Centura, and I've been in the RIA world ever since. So I've worked for all three different types of firms, and I'm going to talk about those firms and kind of how they came to be and how the services have kind of gotten developed over time, if you will. Okay, so I think before we dive into investment management and planning, I think it's helpful to understand where firms came from. So back in mid-1800s, when there was Rockefeller-type money, the only people that really did planning or anything was trust and estates, right? You kind of had those services in place for those really wealthy folks. Excuse me. In the late 1960s through the 1980s, really the financial planning industry began. And there was a group in Chicago that kind of got together, started creating different accreditations and certifications and things. But what it was really doing is people were starting to make more money, and some of the investment type philosophies, investing and making money or thinking about cash flow, started to become important to people. So these planners got together and started to bring these services together. Okay. After that, the internet era kind of came about, right? So the internet came up, and that sort of changed the dynamics. And then after the internet, RIAs really started to come in. And so I want to talk a little bit about how those things developed and why through the context of investments and planning.
Okay. So let's give a quick history lesson here. I know we call him the professor. He really likes this stuff, but how do we do this quickly to get on to?
Yeah. So let's just start in the 80s. So, we kind of got through the period where people are starting to make more money and planning and investments are coming to them. Okay, so let's start with that period. You could watch movies like Wall Street or those kinds of things. And back in those days, you could be a stockbroker. I could call you up, sell you a stock, and make a big commission just for doing that, right? So that was kind of the early days of how do I bring investments to the common person. And for doing that, there weren't really efficient markets or tools where investors could do that on their own. So you needed a middleman, and that was a broker. right? So broker dealers really started to emerge at that point, and that is salespeople at firms offering products that their firms endorse. And so stockbrokers, I think, is a good example of that, kind of in the early 80s and 90s.
Okay, so that went away in probably mid to late 90s into there were still some hanger-oners, but the RIA industry really got ramped up when late 80s started, still infancy in getting through the 90s, and didn't really take hold until the 2000s.
That's right. So I think what's important, I mentioned it earlier, was the internet era, right? So the advent of the internet sort of changed things. That created
access to information.
Exactly. So now the average person didn't necessarily need that broker to get certain investments.
Well, I think a couple things, though. Went from decimals, right, to fractions, right? I mean, from fractions to decimals.
In terms
right?
of the commission.
Right, and the commissions,
yes.
Which really, and information became far more available.
Correct.
Right? And the way to actually, with the internet, now you can set up your own accounts, right?
That's right.
So
yeah, I mean, in the early days of the internet, you had discount brokers, you still had the full service brokers, right? They were offering different services, and that created sort of that fee competition that you're discussing.
Yep.
And that got rid of commissions on the brokerage side, started doing lower cost trades. People started doing stuff on their own. Then the information came in, and now they're like, man, I can really do this, right? There was lots of competition out there. So all of that led to exactly what you're describing. And I think through that internet period, it became, margins on the investments were coming down for these investment firms, and they started to think about how can we make those up. And I think there's a lot of pieces around the fiduciary standard that started to give rise where, acting in the best interest of a client became important. And so thinking about the entirety of their financial situation and assets sort of, I think, gave rise to the next phase, which is really the RIAs. And we'll talk about that. But
so you mentioned a fiduciary standard. Prior to that standard was what?
More of a suitability
standard.
Yeah. Whereas, as long as an investment was suitable, given the context of what I know about you and facts and circumstances, then I could recommend it. Right.
Yeah. So then gives way to the fiduciary standard, which says I need to provide you the best in class of whether it be an asset from an investment standpoint or a fee service. I got to find you the best in class.
Exactly. And that's why RIAs really were able to spring up.
What is an RIA?
So an RIA is a registered investment advisor. And starting in 2001 till present, it's been a compound annual growth rate of over 8% in the industry. So it's been significant growth. And in my opinion, the reason why is because RIAs typically offer fee-based services. And so they'll charge a fee, talk more about that. They could earn commissions on insurance and things, but typically it's fee-based advice. And they're going to act in the best interest of their clients, which means they're going to gather all the facts, assumptions, and goals, and then look at the world of investments and opportunities out there to choose what is in their best interest, not necessarily just what their firm has endorsed, which would fall more to the suitability standard. So it really opened up the opportunities and became much more objective in terms of the advice that was being delivered.
Regarding the investments, we've been speaking about the investments.
Correct.
So let's pivot over to the planning. I know that here at our firm, we break down planning between above line and below line services.
Yeah.
Why don't we spend a moment about that? What are the below line services that we say are necessary, but they provide incremental value, but don't provide exponential value?
I think the below the line services, in my view, really support the investment direction. It's things like cash flow planning, asset allocation, asset location, and some stress testing. So that lets you understand enough about a client's situation to make some investment recommendations and typically be within the ballpark of where where you need to be. And so that's below the line planning, those types of services.
And it's helpful. It keeps you on track at where you're headed. You're on a trip and you want to use a sailing analogy. You're jibing and tacking back and forth across that straight line. You want to stay as close to that line as possible because we know in geometry, the quickest distance between 2 points is a straight line. So you want to go back and forth across that line to make, and those things do that. All those below the line services
For
that
sure.
we say, it's incremental value.
Yeah, there's definitely value there. And that's in the eye of the beholder. Some may get more value out of that than others. But there is, we call it incremental or marginal value.
Yeah. So what is the above the line? Just sounds better. Above the line.
We called it above the line, but it's really talking about three things: income tax planning, wealth transfer planning, and then balance sheet optimization. And so this is really bringing in the world of CPAs and tax.
Income tax planning. Doesn't my CPA do that?
We've talked about this on prior podcasts and dug into it in much more depth. So check those out if you're more interested. But in our view, CPAs are really mostly involved in compliance work. They look backwards and maybe at this year, maybe 1 year forward, but they're not really in forward-looking tax consulting. We've found very few that are. And so that's really where we think the opportunity is from an income tax standpoint is this year plus the next 5, 10, and how does that look for you? And what can we do to plan around that?
What are the tools available in looking out on the horizon? You next mentioned wealth transfer planning. Don't most estate planning attorneys do that? They
do. And they do a good job. I think most, generally speaking, do a good job. In my experience, and I think our collective experience, what we find is that they don't have the amount of time necessary to spend with the clients to really get a full and complete picture of the facts, assumptions, and goals. And so they tend to work more on like a transaction basis or a one-off. And so they may do a great job on that transaction, but it may be at the expense of something else going on in the estate, and they may not even be aware of that. So I think the ability to shed light and information, particularly around facts, assumptions, and goals, can really help wealth transfer specialists do an even better job than they do.
I couldn't agree more. I think that the estate planners we work with across the country are very, very delighted that we have spent the laboring oar of gathering it all, putting it all together so that they can really have a whole picture and create more well-crafted estate plans. I wholeheartedly agree. What's the third thing in the above the line?
Balance sheet optimization. Right?
What does that mean?
So if you look at someone's balance sheet and kind of separate it from a tax sheltered to, a taxable estate perspective, there's all kinds of things that are often amiss or could be improved or optimized or laid out in different ways. So it could just be assets registered wrong or beneficiaries that are missing, but it could be more complex, like owning certain assets in the estate or out of the estate that should be in a different place. So
managing their debt, what vintage, especially with where interest rates are, it could be all kinds of different things about assets and liabilities. Are we being super efficient? Have we thought about this and are we accomplishing what we're trying to accomplish the most efficient way possible?
That's right. Yeah. And there's a lot that goes into that, but it's really rounding out kind of all of the other pieces where things could fall through the cracks.
Yeah. So that above the line planning, we say, is exponential, can provide exponential to the right set of clients.
Yeah.
Right. So the people that we take on are people where we can see where we can add exponential value.
And that really changes the facts, right? If you compare and contrast that for the below the line has a certain set of facts they work with and they model. But if you can change that fact set by doing things in advance of that, particularly around income tax planning as an example, you can change the fact set and the entire game altogether. So it's really important to start there because it becomes an input for cash flow planning, investments, and other stuff that goes on.
100%. So oftentimes, we hear that a lot of firms, most firms, offer planning. Now, planning is a nebulous word. Planning could be going to the supermarket. Planning could be, how do we do our RMD distributions? Right. How do we do year-end tax harvesting? I mean, planning means so many different things to so many different people. But I often hear competitors that say, we bundle planning with our asset management services. And I always wondered to myself, why? Why is that?
I can offer my perspective on it. I've been on that side. But I think, investments are a competitive game, right? There's a lot of...
What do you mean by that? I mean, offering investments as a fee source, as a consultant to advise...
Yeah, if I'm going to manage your money... and I'm going to add value, meaning outperform some benchmark that you could do on your own. There's a lot of firms that try to do that, and it's very competitive. And there's not a lot of managers out there that outperform the benchmark significantly year over year. And I think the access to information for consumers has helped them understand that. And so they're skeptical, but they're also, it just takes time to earn the trust when you're talking about an investment relationship or an asset management relationship, in my experience. And so anything you can do to quicken that trust or value is beneficial, right? So if I'm trying to sell my investment services to you and I can offer you some complementary services, particularly around planning or maybe some trust type, wealth transfer type guidance, that's just basic, then I can potentially add free value to you. And that may incentivize you to actually give me the asset management business.
Okay. So it's service offering to do enough to earn the asset management business.
In my experience, that's what it's been. There may be completely other cases and others may view it differently, but that's what, from my perspective, sitting in that seat and offering planning in with an asset management fee, that was really, hey, here's what I can do for you over and above just the investments. I can really help build a cash flow plan or income plan and make sure the investments support that and line up to it and all that kind of stuff.
Why is a client, in our opinion, delineating services and having the services stand on their own? If we're doing asset management, what is the fee we're charging for the asset management? Does it stand on its own relative to the benchmark based on what it is you're trying to do? We think it should be able to stand on its own.
Correct.
The planning services should be billed separately and should stand on their own as well. And most often we don't see that. We see that they're bundled. And what we have most often see also is they do enough that to get the relationship, to get the AUM, the assets under management, and it's called good enough planning.
That's right.
There's no additional incentive unless there's additional assets or they have something big going on, but there's no additional incentive to spend time there helping them. And so why do we think clients are better served that those services should be split and be able to stand on their own?
I think from my perspective, it becomes much more objective and measurable, right? You can look at, if you're going to charge me for planning, what value are you going to provide me for planning? And if you're not going to provide me value there, do I need it? If you're going to charge me for investment management, what's the value I'm going to get there? And I think that that's fair for consumers to be able to have that information and understand what their options and choices are and where, based on their facts and circumstances, value can be added. It's a little bit different that way versus if it's all bundled together. It's harder as a consumer to understand, am I getting investment value? Am I getting planning value? Is it just the service and the fact I like this guy, or what is the value? And it just becomes harder to quantify, in my opinion.
I think what you're speaking about is a very clear delineated value proposition.
That's right.
What is the value proposition for planning?
Exactly.
I'm paying X. I'm supposed to get Y. Did I get Y? What are the different things that add up to Y for the planning value prop? So
That's exactly
it could be income tax savings. It could be more efficiency about the overall balance sheet. It could be laboring or of coordination. Mm-hmm. It could be managing my professional. It could be all of these and more what you need as a consumer. But
Correct.
What goes into the value proposition for planning? I'm paying X, I'm getting Y. Is it a good value?
Yep.
Same thing on the investment side. What is the value prop there? I'm paying you X. You're supposed to be able to meet this kind of composite index. This is what I want to hear, the measures of risk, whether it be peak to trough drawdown. I don't want it to be more than this, or I don't want my cash flow interrupted, or whatever those risk measures are. Great. Am I meeting those? Mm-hmm. And then am I meeting the return assumptions measured to some kind of benchmark?
That's right.
So delineating those two and separating those two into with clearly defined value propositions is probably, I think, clients are going to feel better about the consumer experience.
I think so. It's more clear where they're getting value from and what the value of those services are. I mean, it'd be weird. There's other industries we could think of, right? Like getting an oil change and then throwing in all kinds of things like a car wash or tire rotation and other kinds of stuff. And if they're like, we throw that in for free in addition to the oil change, you might think to yourself, why? Are you any good at the oil change? Like, what's going on there?
It would cause me, if I came back and you said, hey, by the way, I did these other things. I'm like, I would be a little bit skeptical about your ability to change the oil.
Right. It's just a little weird. We'd want to clarify that, right?
Yeah.
And make sure. And if the other stuff's there, then what are you doing that for?
You go to the dentist and he says, all right, get change behind that sheet. You're like, whoa, what am I doing here? Right?
Different.
Different experience.
Is that needed?
I hear you.
You know what I mean?
It seems odd. I think in financial services, people want to spend time with prospects to build that relationship of trust. And so by spending the time, they're fostering, building, and getting to know more about that person, and then planning kind of facilitates that. But may be helpful, but it may not run with the course of services over time after they've landed the assets.
That's right. Something that comes to mind is even conglomerates. You look back, we talked about history a little bit, but back in the 80s and stuff, corporate conglomerates was sort of sold as a way to, diversify risk, get into different industries, all this kind of stuff. And then as investors could kind of get access to different investments, they're like, well, do I really need this company and all these industries where they're not specialists running these companies, or should I just be able to buy individual companies and stocks that do that on my own, right? And I think consumers over time generally like to be able to be in control, have some ability to pick and choose where they see value and where they see a lack of value. And I think what we're talking about here kind of aligns with the spirit of consumers and what they want. And so I think that, going forward, I wouldn't be surprised if you see an unbundling of services and more firms starting to charge or even specialize in different areas where they maybe can add value versus areas they can't. And I think the industry is going to change in some of those ways.
Yeah. So, you've heard over the last decade or so that there is fee compression, but then the data has come in. The studies are not showing a lot of fee compression.
No, it's been pretty flat, right?
It's been pretty flat.
Yeah.
You're seeing a lot of firms add additional bundling of services, but you're seeing the fees charged about the same.
Right.
Seems odd. And I think we should delineate between the net worth and incomes of people. And so when we're talking about people that have incomes north of, call it $2 million in taxable income, those are the people that we think that really need income tax planning and to look at your overall situation. And typically those people have net worth 20 million and higher. Those are the people that we believe, for the most part, really can benefit from planning, largely income tax planning, wealth transfer planning, balance sheet optimization. They really can benefit by those services. For people that are significantly less wealthy, maybe the bundling of services is okay, but I think you need to be aware that, look, it's a good enough. They're doing enough. We are interviewing a lot of planners elsewhere across the country, and one big firm has bought another big firm, and when they've got there, they said, no, this is how we do it. We see a fair bit of frustration. We've probably talked to at least 10 different planners that are planning on going to it somewhere else, and they don't really have the same standard of care that I had with the last place, and so that's causing frustration. I think that's pretty widespread. I think that's what I see. So
yeah, I think that's fair. The folks, I agree with your assessment of 2 million in income and above, and call it 20 million of net worth, because they have enough tax paying and enough assets to utilize the tools that at least we are aware of and specialize in to be able to bring to them for results. And you're right, maybe below that, where those tools aren't applicable, maybe you do need some other services thrown in there in order to justify the cost, or otherwise cost goes down, and maybe those things are put back on the consumer to do themselves, and there's value there. So you're right. Maybe bundling those things in a different segment works. And if we extract the segment that we work with, which is the high income, high net worth group that we've described here, that's where I think there's a lot more tools that are available and applicable. And that's really where, when we talk about game-changing results and all that kind of stuff, it really lies. So it's probably not for everybody. And I agree, the industry may be different in that regard. So
we hear a lot about that the AUM fee model is dead. Like, this is going to change. It's dead. Can you talk a little bit about that? I see a fair bit of press around that.
Yeah. So, it's something like this. I think if you look at RIAs, there are a minority that charge for planning services. So most of them still charge for AUM. The broker-dealers still charge, fees for AUM, and there's also commissions tied in different firms in different ways. But if you think about the AUM fee model, I think what we'll ultimately get to is a little bit more of a bifurcated service line, where you at least do have some idea of what the value is or what the time commitment is that you may have from a particular group. And they may charge the same fee, but it may be allocated to the different services differently or something of that nature. But I think as a whole, in order for advisors to have enough meat on the bone to really spend the time studying investments and markets and taxes and all that kind of stuff, and to put it to work for clients, they do need to have a certain level of compensation. And that compensation, whether it's all charged on the assets or whether it comes from a combination of assets and fees for planning, I think that will vary by firm. But overall, I see the overall spirit of the AUM model staying intact. It may come from different areas, but I think largely that's what supports advisors and gives them the incentive to go to bat for clients and really do a great job. And absent that, they maybe don't have the incentive to do that, and you maybe get less than stellar results. And personally, I would rather pay for quality results if that's what's going to be there. And I think as a whole, there's been a lot of studies out there showing that advisors do add value and do pay for their fee and then some. So I know here at Centura, we always talk about how do we cover the cost of our services, whether it's through fee negotiations or strategic type moves, or
You're talking about on the asset management side.
correct. Yeah.
Yeah.
So, the AUM fee model, I think is the spirit of that's going to stay intact, but you may see it bifurcated out a little bit with other service lines like planning or maybe even insurance or something like that, consulting type stuff.
Okay. So let's help consumers. Like, what should they do? Maybe I have an advisor, I have a CPA, I have an estate planning attorney. I think I'm being underserved. I mean, we wholeheartedly agree. Most people we meet are way underserved. What should they do? Like, give me the steps 1, 2, 3.
Ask questions first. If you have professionals in your life, ask some questions. So, ask your CPA, do they do consulting work, or is it all compliance? Understand the nature of their business, right? Okay. Same thing with your estate planning attorney. Ask, what types of transactions they do. Are they down the middle? Do they like to get into the gray? Understand a little bit about them and where they fall. Right. I think those are things that are important to understand the professional team that you're working with.
So how about a needs analysis? How do they do a self-assessment needs analysis on what they need?
That, I think there's good information out there. It may be a little bit harder. I think, from our perspective, we kind of look at it as above the line pain or need, right? So you have tax pain as an example.
Income tax pain.
Right. So if you feel like, God, I'm paying a heck of a lot in income tax and I'd really like to see if I could do something about it, that may be a question to start with your CPA or, tax counsel, whoever that is, to see, are they the person that could help you with that? At the same time, if you feel like you have anxiety over where the estate tax exemption levels are, or where the size of your estate's going to be, and you have curiosity around wealth transfer or putting things in place for charity or your children or anything like that, I think it's important to interview, your estate planning attorney. And sometimes people don't have one or don't know where to start, right? And in that case, who do you ask? So in those cases, a financial advisor could be very helpful because the financial advisor can sort of serve as the hub in this hub and spoke type relationship, right? You have these different professionals that sit on these different spokes, but an advisor can sit right in the center. And so if you're going to work with an advisor, they can help you interview those professionals. That's the services that we provide, for example, to help qualify and vet and try to get the needs analysis done. So I think if you're comfortable on your own assessing what your tax pain is and how your professional roster may be able to serve that, then that would be the way to go and ask some questions. And if you find that you aren't in a position to do that on your own, then working with a financial advisor may be very fruitful for you. And then it gets into, how is that advisor compensated, right? Are they going to ask for your assets right up front in order to work with you? Are they going to charge you a planning engagement to understand what's going on in your situation and how to help you, or something else, right? So there's different ways that an advisor may work with you. And that gets to the spirit of what we're talking about here. So I think understanding your situation, being able to communicate that to a capable advisor who has a network of professionals may be a good way to go there.
So just to recap, I think it's doing a self-assessment on what your needs are. Then it's asking the professionals that are currently serving you. And really, the question should be around process. Great. Do you do income tax planning? Okay. Tell me about your process, whether it's CPA or your financial advisor. Same with the other things that are going on for yourself. Like, I need a full insurance review, whatever it is that is needed is great. And what is the process by which you get to answers to figure out, okay, what are the options that should be considered?
That's very important, yeah, because that's how they're going to work with you and give you kind of an idea of what that experience is going to look like. And if they can't articulate the process or they don't do it all the time, that may be insightful. And if they can lay it out exactly what they do and show you, that's also very telling. So I think that's a great way to understand what they or how they do what they say they do.
Okay. Let's talk as a final leg here today about income tax planning around people that own their business. Oftentimes, I had a call this morning. Hey, I'm really thinking about selling my business. I'd heard about this the last couple of months, but I've got 3 or 4 people that are significant people that don't own shares. And we'd shared, look, you're going to end up, they're going to pay ordinary income tax. You're going to compensate them at closing. Like, man, I would love a solution around that. I think that oftentimes clients have no idea what the value of their business is. Mm-hmm. And they're ill-prepared, not often, almost always ill-prepared for that out of the blue offer, mm-hmm. right? So what do you recommend clients that have, they have a founder-led business and they don't have a plan? What do you think those folks ought to do? What are the questions they should be asking their CPA and financial advisor to make sure that they are prepared?
So I think a lot of the spirit of it it starts with what we're discussing, right? So starting with either the CPA or the financial advisor, understanding, are they compliance oriented? Are they consulting oriented? And are they looking at your situation on a go forward basis? So that out of the blue offer could happen at any point, right? A lot of the business owners that we work with maybe say, I'd like to exit this business in 5 years, but who knows what may happen before then or after, right? So nothing ever works out exactly the way they plan it. And from that standpoint, we call it the gold period, which is before you have any offers on the table, any LOIs, right? It's before you've even thought about the sales stuff, but it's setting things up the right way. And that's the time when you can really work in an objective way with proper counsel, whether it's your CPA or your advisor, even your estate planning attorney, other attorneys. But you can really lay out the facts, assumptions, and goals and start asking those questions around what's possible. And when you start to understand what's possible, then you get information and you can make informed decisions about what's best for you and your family or your facts and circumstances, however you think about it. But I think that's the point, is to get started before you have any inkling of a sale that's going on, which would be in that gold period, to say, what's important to me if this does happen? It's kind of scenario modeling, if you will, to walk through that future event, see how you'll feel, see how your employees would feel, and really visualize what's that like and how would it be, and is it set up today to do what you want to do? And that's where you can have legacy planning, all kinds of other stuff that gets involved with that. But I think the business owners that do that and ultimately experience that event are very happy with the results.
Well, this has been very interesting today, talking about the financial planning models and asset management models and how they at most firms bundle those services together. We think for people that have reached a certain level of income and net worth should really consider about having those services separated so that you really have a benchmark as to what it is what are the metrics that you're trying to achieve for each of those service lines and fees that you're paying. Give us a final last thought, Sean, in closing today.
Yeah, I think it's just that, the world of financial advice is complicated. There's all kinds of stuff, income tax, wealth transfer taxes, investments, et cetera. I think there's a lot of folks out there that maybe think they could do it themselves or have even done a good job of it themselves. But once you get to a certain level of net worth or complexity, it really comes down to will, skill, and time. And if you don't have the desire to do it, you feel like you don't have the skill to do it, or if you feel like you just don't want to or have the time to do it, then it's really a point in your life when you should get a financial advisor involved and have them help you go through this process if you don't already have those professionals or those folks to lean on. And if you do, work with them, lean on them, and have them help you, because they're out there and, they charge for services. They do, but that's to incentivize them to do a great job for you. And I wholeheartedly believe that we do, and I know other advisors do as well. So if you find yourself lacking will, skill, or time to do the planning and investments, go talk to somebody, ask some questions, find someone to help you, because there's value to be had.
Get a second opinion.
Yeah.
Words to live by. Sean, thank you so much for your time today.
Thanks, Derek.
Wendy, thank you for hosting us today on the Live Life Liberated podcast. Any final message from you, Wendy?
Well, I would like to know how someone can get in touch with Centura Wealth Advisory.
I think it's best to go to our website, and you can find us at Centura Wealth, CENTURA Wealth, WEALTH.com, CenturaWealth.com.
And take it a little easy on Sean. You're just hammering him with questions, just hammering him.
Good fun. I like it.
Sean, thanks for being with us today. Wendy, thanks for hosting us today. And the last thank you always goes to you, the listening audience. Thank you for listening to us today. And we hope to see you on the next podcast on the Live Life Liberated podcast.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.